Hey there, what's up? How you doing, folks? Welcome to another Futures Trader to a slightly lesser extent. He's been trading for around about 25 years now. His typical holding time for any given trade is just a couple of days, and he classifies himself as an aggressive trader, which I think you'll pick up on that pretty quickly also. In this interview, you'll hear I ask John about the multiple boom and bust cycles he endured over the space of about 8 years before gaining any real consistency. I also ask, is a high risk tolerance essential for becoming a successful trader? So you'll get John's take on that as well. Then we get into some talk about options, and John has some really great advice for those who are still trying to find their feet. Additionally, we talk about indicators and technical analysis, and we go step by step through John's $1 million Tesla trade. So there's a lot packed into this episode. I hope you enjoy it, but more than that, I hope you can take at least just one thing away from this and apply it to your own trading. Okay, let's get to it. Here is my interview with John Carter. Okay, and we're rolling. John, it's good to be speaking with you, buddy. How you doing?
Good, Aaron. Thanks for having me on. It's a pleasure, and hope you're up bright and early out there in Australia. It's evening time over here, so I can probably have a beer and you can't at this time, but
Always up nice and early. So thank you very much for being here, John. I really do appreciate you taking the time to do this. I'm sure you have a very busy schedule on your hands, but I'm glad you could fit this in. So as we're recording this, we're just about to close out the first quarter for 2016. I'd like to ask, how has trading been for you this year so far?
you know it's been really good. I'll tell you specifically about the account that I like to use. I which is rare. I was 100% flat as of December 31st. I just didn't understand the markets, and I was a little upset at myself because as a trader, I love the short side, and so I wake up the first trading day of the year, and the markets are just getting hammered. And when they're getting hammered, it's hard to get in. And so the first week, I literally just watched the markets collapse, and it was a little painful. I mean, on the one hand, at least I wasn't long. But on the other hand, as a trader, you don't like missing moves like that. And so it took me a little while to get into a groove. And I would say that then when I started trading, it was a little hit or miss. And then so the account that I use, I have this, I start every year back at about $180,000, and it's my model account. This is the one that everybody in our trading room can see. And I'm pretty transparent. It's just like, hey, these are my winning trades. These are my losing trades. I show my P&L. So as of today's close, that $185,000 account's at $307,000. So I think that's up about 60 some odd percent. I mean, I'm a very aggressive trader, but the goal is, and this has been mostly options trades with some futures trades, but my goal with this account is to turn it into $1 million by the end of the year. So I'm either going to do great or I'm going to fall flat on my face, and then everybody gets to watch me.
Okay, well, it sounds like you're off to a good start. That's for sure. That's you're doing really well. So props to you. Now you said something really interesting right at the start there about how the market sort of took off, and you were upset that you weren't in it. Like, how do you deal with that? Do you just realize that you've potentially missed the move and you know that you have to sit on your hands now, or do you jump into it with a smaller position size? Like, how do you manage those sorts of situations? Because I know it can be very frustrating when you see a move which you were kind of anticipating, but it just takes off without you and you're not on it. How do you deal with that?
It's one of those things you would think, and I've been trading, I would say actively now for almost 25 years, which isn't crazy because it seems like it was just yesterday. But with experience comes patience, and that was one of my mentors, and it didn't sink in when they taught me this. One of my mentors, after about 6 years of trading, sat me down and said, "Look, this guy had been trading for like 30 years." He said, look, the difference between traders who can do this for a living and those who can't is patience. Patience to wait for the right opportunity, patience to sit in a winning trade. And he's like, otherwise, it's game over. And I didn't appreciate that at the time. But what I've learned, and also my father, who kind of got me into trading, every once in a while, I remember when I first started, I'd say, oh, God, I can't believe I missed this move. And he just laughed. He's like, look, I promise you the markets are going to be open tomorrow and there's going to be another opportunity. And so what happened was I sat there for a week doing nothing, and it was so painful because at least the U.S. markets, I mean, the Dow was down 300 points a day, and had I been positioned correctly, I just could have made a lot of money. And it's frustrating, but what I've learned in doing this over time is that when you get emotional and you chase, um, you just you get yourself in a mindset where you actually miss what's really going on, and you get yourself in a mindset that when a real opportunity comes along, you're just not ready because you're chasing, you're emotionally vested in something that it wasn't really a setup. You just felt like you were being left out, and that's just something that comes with experience. I mean, at some point you can kind of snap your fingers and say, okay, I'm not going to chase stuff anymore. But after a while, what happens is you just learn the opportunity cost of doing that. First of all, you're usually getting, the last one to get in. And then secondly, your brain's all messed up because, it's a purely emotional trade, and emotional trades just over the long run just aren't consistent. So, and that's how I've learned to kind of deal with it.
Sure, sure. Okay. No, I think you answered that really well. There's a lot of really great insight in that answer. We're off to a good start. So I'd like to ask you, you've already kind of mentioned that there's some market blood that runs in the family. Tell us about how you actually first got into trading.
So when I was 18, I was working at a mall at a cookie store, which was a thankless job. You made like $4 an hour, and making cookie dough and then selling cookies to kids that came up, with their moms at the mall. And over the course of a summer, I'd saved up about $1,000. And I came home towards the end of the summer. It was a Sunday night. My dad and his friends, they're sitting around the table. They got copies of Investor's Business Daily. And as I'm walking by, I just hear someone say, well, gosh, I'd probably make $1,000 on that trade. And and in my mind, I'm going like, well, I've got $1,000 in my bank account now. So so I just kind of asked, what are you guys talking about? So the short version is I had no idea what they were talking about, but they were going to buy some call options on Intel that week. And I didn't know what Intel was. I didn't know what a call option was, but I said, look, I'm 18. I got nothing to lose. I was like, can I open an account and do this trade? And they're like, well, you're not going to have time to open an account and fill out all the paperwork, but we'll spot you. Give us $1,000. I'll buy 10 contracts for you. And if it loses money, you're SOL, shit out of luck. But if it makes money, we'll give it to you. Like, done. So what happened is that these options that they bought at $1, they sold it at $1.80. So I had worked for 3 months, 8 hours a day, 5 days a week to make $1,000. And now in the course of 5 days doing absolutely nothing, I made $800. And at that point I was hooked. And it was, I just kind of realized how the power of having your own money work for you instead of, doing physical labor. I mean, not that there's anything wrong with physical labor. It's good to get out and work, but it was just, we're worth so much more than what somebody's willing to pay us per hour is really what it came down to.
No doubt. And I think that's what, a lot of traders realize and what's got them, pursuing this. So yeah, no, I totally understand where you're coming from. Now, in past interviews, I've heard you talk about when you did start getting into trading, you went through several boom and bust cycles. I'd love to ask you, like, what did those boom and bust cycles actually look like?
So I've always been a pretty decent risk taker for whatever reason. I mean, I think everybody's just wired. You're kind of born with inherent things. And when I started trading, I was very good at making a lot of money, and then I would lose it. So there was 3 times over the course of my college and my working career where I'd have, say, $10,000, and then over the course of about a year, I would run it up to like $100,000. And I was taking crazy risks in terms of position sizing. It's like, wow, I like this, so I'm just going to put my entire account into this trade. And if it worked, great. And if it didn't work, I So what would typically happen is I'd have $10,000, it would jump to 20, drop back to 13, jump up to 27, drop back to, 18. But what would happen is when I'd get to about $120,000, I would step back and go, wow, I just went from 10 to like 100. So now I'm going to go from 100 to like 1 million. And what happened was, and it just took me forever to figure this out. But what I finally figured out is that I started focusing on the $1 million. Before, I was just trading. I didn't have a goal. I was just like, here's a trade. Let's take it. I want to make some money. But when I started focusing on, I'm going to make $1 million, I changed my trading approach. And what would happen is if I had a losing trade, whereas before I would just get out, I'm like, this isn't working, get me out of this. What happened is that I would say, gosh, I'm trying to make $1 million, so I can't take this loss. I've got to at least get out at break even. So I started doing stupid things. And so that happened to me 3 times where I would, make this money, blow it up. And after the 3rd time, I went through kind of a very kind of a gut wrenching learning cycle and kind of, conversation with myself going like, do I want to keep putting myself through this? And at the time I was just about to get married. It's like, if I'm going to get married and have kids, am I going to put my family through this? And I just had to come to terms with what was it that I was doing? And so that's what I kind of figured out. I mean, I ran across Mark Douglas's book, The Disciplined Trader, at that point, and then Trading in the Zone. That helped a lot. Talked to some traders, and then I just said, all right, if I'm going to do this, let's act like a professional. Don't try to quote unquote, make $1 million, and let's do this. And that changed things. It didn't mean that I never had obviously losing trades or drawdowns, but I never blew up an account after that.
Okay, sure. So a couple things I'd like to ask you, just to bounce off your response there. You obviously, by nature, have quite a big appetite for risk. You're very comfortable in many ways taking large amounts of risk. Do you think that's a necessary trait to be a successful trader?
So there's a fine line. You can take too much risk, but I think I don't know what is worse. If it's, if you have an appetite for too much risk or if you're too conservative. And I've seen both. And obviously too much risk opens up the door of you're going to make a lot of money and then you're just going to blow up. I mean, that's the too much risk scenario. If you have too much fear though, I mean, the good news is with too much fear, you're not going to lose a lot, but you're not going to make a living as a trader either. And I think that's one of the things that, people kind of confuse is that, let's say, you've got whatever amount of money that you have to trade with, $50,000, $10,000, whatever it is. But I think one of the goals of a lot of people, and this was certainly my goal for a while, was, okay, I'm working at this job, I'm getting this check. And when I was working in the corporate world, at one point I was making right up at around $100,000 a year. So I was like, all right, if I'm going to quit my job, I need to make, $8,500 a month trading. And what happens is that if you're too aggressive in that situation, your account's making swings that don't make sense with your goals. But if you're too fearful, you're going to not make nearly enough money to meet your goals. The biggest problem with being too fearful is that you wait, as a trader, you wait for confirmation. And the problem with waiting for confirmation in trading is that by the time something is confirmed and all the indicators are aligned that this is a buy signal, that's usually the time that you should be taking profits. Like, everybody's looking at the same charts. And if everybody thinks that something looks good and everybody's long, no one's left to buy. And at that point, it rolls over. And so that's why sometimes it feels like, if you're in a pattern where you're buying something and as soon as you buy something, it goes down. Well, usually it's because there's 27 indicators that someone's been watching, and now they're finally all lined up. So you feel quote unquote safe to take the trade. But, at that point, it's like, now it's so obvious that everybody's getting out.
Right. Okay. And we might get into that a little bit more in just a bit. The other thing I was going to ask you was, you mentioned Mark Douglas's book, Trading in the Zone. I've heard you speak about this in the past also. What was it about this book that was such a huge help in getting you to the point where you could achieve consistency? Like, what was it about this book that really clicked with you?
The one of the things, and when I first read the books, I didn't know Mark. I eventually got to know him, and we became friends. And he recently passed in August, which was was a complete surprise. But his knowledge of the markets, and B, the human mind, and then C, how the two interacted, is unparalleled. And I just anybody who's discretion making their own trade decisions, i.e., they're not just turning it over to a computer. Anyone who's making their own trade decisions without having read Mark Douglas's books is at a disadvantage, because he's just learned, and he's got an intuitive sense of how the markets like prey on people. And it does. I mean, it sucks people in at the wrong time. It's just all these weird things. And it's just, you just learn that the main thing that you learn from reading Mark's books is that to trade successfully, you've got to understand what your mind should be thinking while you're in a trade. And how your mind should be thinking while you're in a trade is about probabilities. And you need to have a probabilistic mindset, meaning that, hey, you know what? Anything can happen. Just because I'm long doesn't mean the stock's going to go up. Anything can happen. And if you realize that anything can happen, then you kind of get a little bit more relaxed. You focus more on risk. You don't take small profits, because if anything could happen, it could turn into a big winner. And when I got my arms wrapped around that, I mean, my trading just changed. It's one of those like, wow, my winners are bigger now and my losses are smaller. This is amazing.
Okay. So just so we can put this into perspective, so from the point where you got started, you came into trading, you went through these boom and bust cycles 3 times over, until the point where you achieved some sort of consistency, how long was that time frame?
Gosh, that's a good question. Okay, so I traded. I would say that my learning curve for trading was probably longer than most people's, and the reason for that is because I stuck with it longer than I should have. A lot of people I know, they try trading for 2 years, it doesn't work, and they give up. So, and I'll back up here a little bit. And there's a reason. The reason I was able to last longer, I guess, is that when I had those 3 boom and bust cycles, and I would take 10,000 and turn it into like 130,000, and then think like, okay, I'm going to make $1 million. The one smart thing I would do is that I would say, all right, I'm going to take 30,000 out. I'm going to put it into real estate. I'm going to put down payments on 2 houses, and I'm going to rent them out. And so what happened is that there's two things that happen there. One, by the time I busted my 3rd account, I actually had some real estate. So when I finally was like, I'm going to take this for real, I could sell that real estate, and raise another stake. So that was semi-important. But, the idea that you can always get a stake. I mean, you can, if you have trading skills, you could trade somebody else's account. I mean, there's always ways to get a stake if you're determined. But the thing is that now I just went off on a tangent, so I kind of forgot the question. So what was the question?
I was asking you about how long it took you from when you first started out up until the point where you achieved some form of consistency. Like, how long was that time frame?
Okay, so at this point, when I finally read Mark Douglas's book and I went through all that, it was 8 years, and it was and I put my fiance through hell. I mean, there was a couple of times where we were going to buy a house and couldn't buy the house because I blew up an account. I mean, that kind of stuff. And we're still married to this day and have kids, so she's a keeper. But part of my mission. I mean, I love trading. At the end of the day, my life would be a lot easier if I just traded. But I don't think it needs to be 8 years of frustration to learn how to trade. I think you got to put in the time. I mean, nobody's going to learn on day one, but I like to compress the learning curve with other folks. For me, it took 8 years. I think for the average trader that has the right tools, it can be 2 years. And the reason I say that is that people have to figure out, they have to see different market conditions. And the one thing that's unknown is how people react. If you've got money on the line and the market starts going against you or it gaps against you, how are you going to react? Are you going to freak out? Are you going to be deer in the headlights? Are you going to be able to calmly take action? And that's a little different for everyone. The sooner that you can get to the point where that you just focus on probabilities and you let go of any emotional attachment to the outcome, the sooner you're going to be consistent.
Okay. All right, John. Well, let's focus in now a little more on how you trade today. So, how would you describe your method and your overall approach to markets?
So, the main thing with that is, I think it's good for every trader to find their sweet spot. So for some people, it's going to be, there's this idea of you need to kind of match your trading to your personality. Now, I am not what I would call, so to me, there's 4 types of trading. There's scalping / day trading, there's swing trading, there's position trading, there's investing. My sweet spot as a swing trader. I don't really have a lot of interest in buying, watching a 1-minute chart, buying something and then selling it, 3 minutes later. Now, it seems like that's safe and it does create a lot of adrenaline. What a lot of people don't realize is that you generate so much commissions that it's almost impossible to make money. If you have a $20,000 account and you're day trading, it is very likely that you are spending $20,000 a year in commissions. So it's like you have to make 100% a year just to pay your broker. And people you just don't realize that until you start tracking it. So to me, the sweet spot though is, within 5 minutes, that's not worth it. Over the course of 3 months, I think it's just hard to predict. But, 2 days to 2 weeks, that's kind of my sweet spot. And so that's what I'm interested in. So I'm not looking at 5-minute charts during the day. And by the way, one of the best things I ever did was just took my 5-minute charts and just threw them away. I look at 30-minute charts, basically kind of hourly charts, then daily and weekly charts. And I'm just looking for setups that I want to be in something. If I'm buying something on Tuesday, I'm like, I want to be, the earliest I would sell it is Thursday unless I'm stopped out. And that to me is a nice sweet spot. You can get aggressive. You can catch nice little pops. And the markets tend to do that. They tend to move in little pops and then consolidate. And so that's what I kind of look for. And that for me works really well.
Okay. And what markets or products are you most actively trading?
I cut my teeth on the stock index futures. So I like the stock indexes in the US. So the, E-mini S&Ps, E-mini NASDAQ. But I'm also a big options trader on individual stocks. So, and the two are very complementary. So, if I'm bullish on the ES, then great. What are the strongest stocks? Tesla, Google, Amazon. Then I could buy some call options on those. And so to me, those all work together. I'm also big on correlations. It's like, okay, if the yen futures are going higher, is that going to mean, weakness for stocks and things like that? So I do like to look at kind of those leverage instruments. And I'm a big believer that, and I watch the Australian dollar too. And, the fact that, when oil and gold were coming off and, Australia, here's a funny story. In 2008, I actually flew out to Australia to give a talk. And I'm a big fan of buying the country that you're going to, buy the currency before you go there, just in case you need it. So I bought it about a month before I went, and I bought it when the ratio of Aussie dollar to USD was 1-to-1. And then by the time I got there in October of 2008, it had fallen in half. So that was that was a really bad trade because I bought them for $1 and they were worth only half that by the time I got there. But that was, the markets, the world economies are all tied in together. And here's the thing is that you don't need to know that. You do not need to know that if the yen goes higher, stocks might go lower. All you have to do is have a handful of good setups. And the traders that I've learned, that have mentored me and have been doing this for 30 plus years, they all have like, oh, I've got 3 setups and I watch 4 markets and that's it. They don't care what's going on. They don't watch the news. They're not looking for the latest tips. They just have their niche and they kind of, grind it out and make some money. And I'm a big believer in that. I actually think the less information you have, the better you'll do, because otherwise you just get distracted.
Okay. Yeah. No, I think that's a great point you raise. Now, something you said a little earlier about, traders might see some sort of consistency after putting in 2 years of good work. And the reason for that was because over that time, they'll experience different market conditions, and, we'll go through different regimes. How did your trading change depending on what type of market we're going through at the time?
That's a good question, because one of the things that it took me a long time to learn is that you don't do the same trades all the time. Is it a bullish market? Is it a bearish market? And so what I think the art of trading has come down to a couple things. One of them is knowing that there are three positions that you can have. You can be long, you can be short, or you can be flat. And the longer I do this, the more I realize that flat is one of the best positions, because when you're flat, your mind is neutral. You're not, there's a saying that I heard by a friend of mine, a trader in London, and he's like, don't piddle away your chips, which is like, in the US, we'd say, don't piss away your capital. And if there's nothing to do and you're bored, just go do something else. Wait, be patient. And right now, the markets are kind of interesting because we had this, super bearish sentiment in January. And then in February, all the signals that I've gotten have been long, but my brain was screaming to be short, which was interesting. And so I've learned to just trust the signals. Like, hey, this is a bullish signal, buy it. And the main thing that I've learned is that, there's first of all, no trading day is alike, but there are kind of cycles. And if it's a bullish cycle, great. If you're in at the beginning of the bullish cycle and you've got some signals that are going in there, load the boat and ride it out. But like right now, we've had this fantastic rally since the beginning of February to now. This is not the time to load the boat on longs, but it's not the time to load the boat on shorts either, because there's no short signals. I'm playing it pretty light. I'm just kind of in hurry up and wait mode. And what I've found in trading is that if you can be patient over the course of a trading year, there's going to be 1 or 2 days a month where if you're focused and you've got a neutral state of mind, you can dive in, have a larger than normal position, and make a killing, and then get out and go flat again. And that's really what it's all about. As a trader, it's hard to do that because you think you should always be trading. But what I found is that for people who get bored and they trade to alleviate their boredom, they just piss away their capital, so that by the time a big trading opportunity comes along, they're just kind of getting back to where they were. And I think that's one of the toughest things to do, but it's one of the most important things to do, is just, if you're looking at the markets and there's nothing to do, don't do anything. You get to the point where it's like, if you look back on your trades and say, wow, God, that trade worked out really well, go back and look at it. What came together? Wait for that to happen again. Go for a larger than average position. Otherwise, stop. Don't piss away your capital. And I think it's just something you just don't know at the beginning, but over time you learn, and it's just a huge lesson.
Yeah, absolutely. Now, just going to the other end of the trade, what's your thought process for deciding when or where to get out of a trade? Like, how do you form an exit plan?
It's a good question. I mean, here at the end of the day, entries are a dime a dozen. To become a good trader, you've got to become a master of exits. And that means, of course, stop losses, but also, targets. And you have to have an idea of what, and this is actually kind of easy in the options world, because options are priced with what's called an expected move. But this also works with futures and stuff like that too. But what I mean by an expected move is that market makers actually study all this stuff, and in options, implied volatility and all this kind of stuff, you can say, oh, wow, okay, the option makers, so Netflix is a $100 stock, and the market makers have priced in an $8 move over the next 2 weeks. Well, guess what? If you've got Netflix as a stock, or if you bought options on it, and it's up $8 from your entry, and that's what the move that was expected by the market makers, get out. I mean, the odds of it going much higher than that are not very high. The other thing I'm a huge fan of is Fibonacci extensions. So whether it's a 5-minute chart or a 30-minute chart or a daily chart or whatever, if a stock makes a new swing high and it gets up to the 1272 extension of that move, from the swing low, at that point, I mean, that's 90% of the time you're going to hit that target, but the odds of it going much past that are low. So, maybe 50% that you'll get to the 1618 extension. So you want to know where the low-hanging fruit is. And I love the idea of like, wow, here's a great setup. I'm going to get 10 contracts. Okay, let's say it's futures. I'm going to get 10 S&P futures contracts. And if we get to the 1272 extension, I'm going to sell 7 of them. Like, let's take the bulk of the risk off the table here. And then if we get to the 1618, great, but I'm going to move my stop to break even here. So I'm going to get aggressive about taking off a large part of my position at those low-hanging fruit targets. I'm not going to hope that the thing's just going to keep moving in my favor forever.
Okay, I like that, the low-hanging fruit. Very good.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So let's talk a little more about options now that you bring it up. So, I know options are one of your main focuses right now, but, over your 20 years, I believe you've traded pretty much every market at some point during your career. What is it about options that you find really attractive?
So for options versus futures, futures, it is, if I look at something like, say, gold, like, okay, I'm bullish on gold. What do? Do I go out and buy some gold futures, or do I buy call options on a stock or ETF like GLD, which mimics gold? Here's the thing. It is harder to hold on to a futures contract. Futures move all the time, and they could blow through your stops. I mean, sometimes gold futures aren't that liquid. What I like about options is that there's 2 things. One, in this example, I could say, like, you know what? I'm willing to risk $5,000 on this. So I could buy some gold call options, $5,000 worth, 60 days out, and just forget about it. Now, gold futures, I might get stopped out on that very easily, but with those gold options, it could come down, and something that would have stopped me out on the futures could turn around and rally strongly, and I end up making a bunch of money on the options. And so what I like about the options is you can just say, like, you know what, I just want to risk $5,000. I'm done. And the gold market could actually have huge fluctuations and you'd be fine. With gold futures, you don't have that luxury, because gold, if you get down to a certain point, you have to get out. It's like, oh, I'm down $5,000. So if you haven't traded options before, that might not make sense. But with options, if you're long an option, it's a fixed amount of risk. And then the other thing is that options are depreciating assets, which are kind of fun, meaning that, so let's, a popular stock in the U.S. markets is Apple. So if Apple's at $105, you could buy a $120 call option for like $1. And you're making this bet that, like, wow, Apple's this amazing stock and it's going to rally up to 120. Well, it's probably not. So you can actually take the opposite side of that trade and just sell it. You sell it for $1, it expires worthless, and then you keep all the money. So with options, there's a lot of fun things you can do in terms of selling them, keeping that money, and that's kind of, you're taking the opposite side of other people who are like buying options that go to zero. So there's a lot of fun things you can do with options.
Okay. Now, listen to your interview on the Option Alpha podcast with Kirk Duplessis, who was actually on episode number 2.
Okay. Yeah, Kurt, he's got a great site.
Yeah. So one of the things you were speaking to him about is with options, you find that they've helped you see more consistency in your results, kind of minimize the drawdowns, less volatility in your actual account. Did I understand that right? Is that something relevant to your choice of, or your decision of trading options?
Well, yeah, and it depends on your goals. If you are looking for a steadier equity curve, meaning like you don't want the up and down, the like all these crazy ups and crazy downs, you can structure trades in a way with options that makes it really consistent. Now, consistency also means you're limiting profit potential, okay? But that's not a bad thing for most people. You can sit there and say, as an example that, I could buy a call option on Tesla at $8, and it's either going to go to 16 or go to 0. Or you could sell, let's say, a put credit spread on Tesla that's out of the money, and the odds of that going, you making a profit on that trade are like 90%. So that's, everybody, the nice thing about options is that you can sit there and just say like, okay, just be honest with yourself. What kind of risk do you want to take? What kind of equity curve do you want? And when I mean that, I just mean that the job of a trader is to have an equity curve that goes from the lower left of the screen to the upper right? It's going higher. It's not about being right. It's about, managing that equity curve. Now, I'm an aggressive trader, so my equity curve is going to have a little bit more zigzag in there. But some people don't like that. They don't want to sit there and go like, oh God, I just had some losses here. They want it to be more consistent. And what's nice about options is that you can kind of construct your trades in such a way so that, you're never going to have any big blow up surprises, but you're not going to have any upside excitement either. You're just steadily cranking out the money. And that's great. And I think that's a very great thing with options, because you can structure your trades in a way that just kind of matches your personality and your own trading goals, which obviously at the end of the day, all that matters here is that everybody's able to meet, figure out their trading goals and then find the right instrument to actually execute those trading goals.
Mm-hmm. Okay. And another thing you mentioned on that podcast was you used the term financing a trade. Now, I didn't quite understand this, but I think it was somewhat interesting. Would you mind expanding on what you mean when you're referring to financing a trade using options?
Sure, and there's a couple of ways to do it. So one way to do it is, since we were talking about gold earlier, I'll use that again, but we could say like, okay, GLD, I think it's going to go higher, over the next 3 months. So I'm going to buy a call option 3 months out. Well, let's say it's at $120. Well, what I could do is, even though my call option is 3 months out, I could sell the $125 options that are 30 days out against those. And in a perfect world, they expire worthless. Okay. And that's kind of like having a rental property. And that's the trade is called a diagonal. So you buy something that's longer term and then you sell shorter term stuff against it. And if the stock moves up methodically, or down methodically, if it's a bearish play, you can do it in such a way that you end up selling enough options against it that it actually pays for itself, which is kind of fun. The other thing in that scenario is you can buy the options. So you could buy, like, say, 10 call options and then sell, a 30 contract put credit spread that ends up expiring worthless, and that could actually pay for the entire trade. So now you got a free trade. So the nice thing with options is that there are things like that you can do. Obviously, on anything like that, it's like, okay, what's the risk here? But the fun thing is you can actually, it's called financing a trade, and once it's financed, you can just kind of let it go and see what it can do.
Okay, so it sounds like something which is a little bit more advanced, but very interesting. Just before we move off the topic of options, is there any advice you'd like to give to, novice options traders that would be really helpful? Maybe some advice that would have been helpful for you when you started getting into options.
I'd say the first thing is that if you're a novice and you're getting into options, usually what you're going to do is if you think it's a stock's going to go higher, you're going to buy a call. If you think it's going to go lower, you're going to buy a put. I mean, that's just kind of the basics there. The mistake that most novice traders make is they look for cheap options. So if you're looking at a stock like, let's use Apple as an example. It's $100 stock. And you'll look at it and say, wow, here's a $100 stock. The $95 calls are $7, but the $110 calls are only $1. So I'm going to buy the $110 calls because they're cheaper. And that's the biggest mistake you can make. Essentially with options, those out-of-the-money options are designed to expire worthless. They're designed to suck people into them. So if you buy an in-the-money option, even though it's quote-unquote more expensive, all you got to think of it is this. Instead of buying Apple for $100, you're buying an option for $7. So for a much cheaper price than actually owning Apple, you're going to be able to participate in the price movement of Apple and do it that way. So I would just say, focus on in-the-money options. And if you graduate from that, start considering spreads, selling put credit spreads or call credit spreads. But you don't really need to go. I remember the first time I went to an options seminar and I started hearing about butterflies and all this kind of stuff. You really don't need to go down that road. If you're bullish on something, buy an in-the-money call, sell a put credit spread, you're done. If you're bearish on something, buy an in-the-money put and sell a call credit spread, you're done. And that's all you need to do.
Okay, and when you say you don't need to go down that road, are you talking about sort of in the early days, or is it not necessary at any point? Is that something you get into these days?
No, I actually don't think it's necessary at any point. I mean, the thing about options that can get, because there's so much math and, they call it the Greeks, Vega, Delta, Gamma. I mean, at least for the kind of trading that I do, it's a distraction. And I know a lot of people get involved in that. And if you talk to market makers, they think it's really important. But it depends on your style of trading. I mean, I look at a chart and I get an opinion based on a setup that this thing's going higher. Well, that's very simple. It's like, if I think it's going to go higher, then I need to buy the right call. And then if I sell a put credit spread and it expires worthless, that's a win. What happens is that and I'm not knocking these strategies because I actually know traders who love this stuff, where it's like, okay, the odds of it going here are X, so I'm gonna buy a butterfly and do this diagonal around it. And people really get into it. I just don't, and I don't think it's necessary. And I think that one of the things with options is don't be intimidated by all these crazy different things that you'll see, because you don't need to do them. If you think something's going higher, buy an in-the-money call. That's all you need to do. I think it's a good idea to learn what a put credit spread means, because that's a benefit, and then you're done. If you want to do more than that, that's fine, but you don't need to.
Okay. Good advice. All right, well, let's talk a little about technical analysis and indicators. So starting with technical analysis, how do you use technical analysis in your trading? Is there anything key that you look for on a chart?
Well, my favorite setup is something called a squeeze. All that is that when the Bollinger Bands are trading inside the Keltner channels, it just means that the standard deviation of a stock or a market is now trading inside of its average true range. And it may sound kind of complicated, but it's just it's one of those things where, if you think of it this way, if an Olympic athlete has just ran a 100-yard dash, they're not going to go run a 100-yard dash immediately after that. They're going to rest. They're going to drink some Gatorade. They're going to get ready for their next event. And it's the same thing with a stock. It's going to have a move, and then it's got to rest and relax and kind of get ready for the next one. What I found is that when the Bollinger Bands contract to the point that they're trading inside of the Keltner channels, and by the way, these are all default settings, are available on most platforms, that's telling you, hey, heads up, this is getting ready to go again. We've got an indicator that we created called the squeeze that kind of makes that a scannable kind of a feature. But that's my main thing. I feel very, very comfortable if I see a stock or a market. It's like, wow, this has a squeeze. This is about, this is ready to do something. And if it's in an uptrend, this is saying like, wow, there's an 87% chance that this uptrend is going to continue. I can work with that, and vice versa if it's in a downtrend. So I keep it fairly simple. There's a lot of other indicators I use, but I always start with that.
Okay. Do you have like a video or an article about where we can actually see that on a chart? Like, any visualizations that I could maybe link to in the show notes?
Yeah, we've got a couple, and if you want, if you have some show notes or something like that, we can send you a link that says, "Hey, here's a good example of that."
Yeah, no, that'd be really cool. So, I'll be sure to include that in the show notes. I think that'd be cool if people can actually visualize something like that. They might want to check that out.
Sure.
Now, don't mean to keep going back to the interview with Option Alpha. I'll also link to that in the show notes too. It was a good interview. One of the things you said, which really struck me, was that you don't look at a chart for more than a split second. I'd love it if you could share your reasoning for this with the listeners.
Yeah, this is another hard lesson I learned. So the good setups, they are right there in front of your face. And if you're looking at a chart for more than a split second, it means that you're trying to force something onto that. I mean, literally the best setups, in half a second, you're like, oh my gosh, that's amazing. Everything's coming together. If it's not like that, then you're going to keep staring at it, and you're going to you're going to try to force something into that that's not actually there. It's not a good setup. The best setups, you can identify them, just like that. And if you can't, move on to the next chart. The toughest thing with that is somebody, you read something in the news. Oh my gosh, Google, this amazing article came out. So you go look at the chart, and the chart looks like crap, but you're like, in your mind, you're like, it should be bullish. So you keep looking at it and all these things and trying to force it into that. Well, your mind's going to see whatever it is. And, if you have a concept in your mind of this stock is bullish, you are going to find something on that chart that says it's bullish, even though it has nothing to do with whatever you've looked at in the past. And that's going to take some time to figure that out. So the answer to that is, like, if you're looking at a chart and if in like a split second you don't see anything, you don't have anything. So it's just the easiest way to do that.
Okay. And do you think that you can identify setups that quickly because you have 20 plus years of market experience and years looking at charts? Or is that something you would say that newer traders should also try to apply to their own trading?
No, I think it's a little combination of both. What happens is, after doing this for 20 plus years, you start learning the setups that give you the best results. So, that's, to be fair, it's like, oh, okay, gosh, anytime that happens, I'm definitely going to, take a position. As a newer trader, what happens is, I call it, there's the natural inclination to search for that holy grail and continue tweaking a chart, adding more indicators, all that kind of fun stuff. But what happens is that, as a newer trader, is that there's this idea of, okay, I want to get long this stock. So you'll keep looking at the stock until you find a reason to go long. Even if it's the most bearish setup on the planet, you can find a reason to go long if you really want to. So what the moral of the story is, have a setup that you like, keep it simple. And I've found that if you have a setup that you can't explain to a 12-year-old, it's too complicated. So, keep it simple. And from there, because you don't actually need a lot of indicators. I mean, you really actually shouldn't have more than like 3. So here's your price, here's 3 indicators, and you're done. If you've got more than that, you've got too many indicators on your chart. And, identify that setup. If you end up using something like a squeeze, great, moving average crossover, it actually really doesn't matter. Just identify what the setup is and then track it. And the secret to that is, whenever you find a setup, just do 25 trades in a row. And at the end of 25 trades, did you make money or lose money? Because, wins and losses, even on a 75% probability, are going to be randomly distributed. Just because you do 4 trades doesn't mean 3 of them are going to be winners. You might have 4 losers in a row. But at the end of 25 trades, you're going to have a good sample set. And if you made money on that, you're going to have more confidence just to say, okay, every time I see that setup, I'm going to take a trade. And that's what you do, and that's where you get to the habit of, in a split second, it's like, oh, that's a setup, great, I'm taking it.
Absolutely. Yeah, no, that's a really great point that you highlight there, John. Now, you have mentioned indicators a few times. When do indicators serve a purpose, and when are they unnecessary noise?
So I know traders that only look at price action, and there are times when that makes sense when you're looking at price action and say trend lines. But at the end of the day, anytime you're looking at, the most classic one I remember as a newer trader was, okay, the market's rallying, but it's overbought because my stochastic is over 80. So I can't buy it. And the market goes up like forever after that. And what happens is that indicator, that overbought indicator, becomes noise against the actual price action. So at the end of the day, it's the price action that matters. Indicators, all they are is a derivative in interpretation of price action. There's no magic involved in indicators. It's just math. And you don't want to let the indicators get in the way of what's actually happening on the screen. So the first thing that's most important is price. And then you kind of look at like, okay, I've got a couple of indicators here, what's going on? But it's easy to get lost in a bunch of different indicators when all that matters is that, the market's either going up or it's going down, and the price is the most important thing. The indicators are merely an interpretation of that.
Okay. That's well said. I like that. Now, one of the things I'm really keen to ask you about, and anyone who follows you is probably aware that you banked I think it was about $1.4 million on a trade. I'm not sure exactly when it was, but could you please share the story with us? Like, walk us through it step by step. I think it would be really interesting.
Sure. No, I remember that trade. I mean, it was like, so I've had a couple of big trades before, but not in one day like that. So I remember, so it was either, so this was in January of 2014. And so it was either January 14th, 15th, or 16th. It was one of those days. But on that day, it was interesting, as I remember on that day that I woke up and I had two trades that weren't doing well, and I got stopped out of both of them. And in that account, I was trading it was $1.5 million account. So it was a pretty decent sized account. I'd lost like $100,000. I was like, all right, that's not what I wanted, but I've been doing this a long time. So I'm like, all right. And as I'm sitting there and I'm now flat, I got stopped out of my positions. And I had noticed that earlier on the day, Tesla was down $10. And then I suddenly noticed that it was up $5. I'm like, what is going on? I mean, Tesla was down $10 and now it's up $5. So, I check on Twitter and it's like Elon Musk said some kind of announcement, like I think it was an earnings, or I don't even know what it was. And then I checked the short interest, and I do like to track the short interest on a stock. And the reason is that and Tesla was like 40% at the time, is that if there's a lot of people who are short, typically over 20%, then if you get some kind of surprise announcement to the upside, they're forced to cover. Plus, there's going to be new buyers, so you can generally get like these huge moves. So I'm looking at that going like, all right, Tesla was down 10, it's up 5. I'm looking at the chart. There's no real resistance, and the prices were like, I think it was at maybe $150 at this point. And there's no resistance till like 170. So I buy 100 call options. And it continues to do well, and I'm buying them like at $6. So, in $1.5 million account, that's a small position. And I keep adding as it goes in my favor. And I get to the point where I have 1,000 call options, which is, that's a pretty sizable position. I even bought a bunch of stock. And it was interesting because there was one point that made the difference for me in that trade, is that at one point I was up, so I'd lost $100,000 on that day. And at one point I was up about $300,000. I was like, okay, this is an amazing trade. I was excited. This is great. I've been doing this a long time. I would be completely happy taking the profit there. But I'm looking at this going like, I think this this is not showing any signs of stopping. The volume is pouring into this, but obviously no stock goes up or down in a straight line. So it started pulling back. And I'm watching my profit that was up $300,000, over the course of like 10 minutes drops to like up $200,000. I'm like, now we're at that moment in time of every trader is like, I don't want this to turn into a losing trade, but oh my God, I think I see a lot of potential here. So I stepped away from the computer and I took a shower. And it was just like I had to get away. I stopped thinking objectively. So I went and took a shower and I came back. Tesla had gone a little bit lower than it stabilized. So I was back to where I was up like 300,000. It's like, okay, looks good. I was at home and I needed to get to the office, and the office was about 20 minutes away. So I hopped in my car, started to drive, and I got there. And by the time I got to the office, then I was up 600,000. So now it broke out again and it started taking off. And it just kind of rallied into the close. And I sold half of the close. I held half overnight. It gapped up 10 points the next morning. It was an amazing trade. And, there were things that, and it's interesting looking at it because it's like, in a perfect world, I could have done a lot better, but, and it was down 10. I didn't buy it until it was up 5. That's a 15-point turnaround. But, the consistently high volume, the ability to sit on a winner is hard. That's training. And that's just something where it's like you recognize like, wow, this thing's moving. There's volume pouring in. Every pullback is being bought. Where is this going to end? And that was just one of those things where like, there's these moments in time in trading where all of your training comes together. And that was one of those times. And obviously, now, I haven't had another $1 million day trade since then. I've had plenty of pretty decent trades. There's been some I've had that it could have been that, but I didn't do as big of a position. So, it's always like, well, why did I think Tesla, would have been a much bigger winner? Well, part of it was the short interest and things like that too. But so it's interesting. So, I think there's always moments in time where, as you do this, you're just like, wow, this is one of those special times where you just hold on, and you've got to have the guts to do it. It's hard. It is hard to hold on to those things. But I love the idea of having concentrated positions on something that's working, and just watching that basket. And, it worked out really well. And, those are the things I still continue to look at.
Yeah. And the part I find really fascinating about that is that you kind of almost knew to push harder on that trade. Like you said, when the trade started working out, you just kept adding to your position. I don't know. How did you know how to push harder on this particular trade?
A big part of that is just recognizing what I would just call a special situation. We've seen those days where, a stock starts off down 5 and then suddenly it's down 30, and a lot of it's volume. That's an easy thing. It's kind of like, this is a special move. the volume is just exploding on this. So that helps. But it's also just understanding. That's the easiest way I can describe it is just a special situation. So, when a stock, breaks it, especially when something that everybody thinks should happen isn't happening. And I remember that because Tesla had fallen. Everybody thought it was overvalued. People were writing articles that it was dead. And then all of a sudden it's like, wow, it's having this huge reversal. So all these people, and by the way, the biggest moves happen when a lot of people are wrong. So big moves don't happen when a lot of people are right. When a lot of people are wrong and they have to get out of that position, that's what causes big moves. So with Tesla, you had this reversal. You had a lot of people who were wrong who were forced to get out of that position. And so you kind of recognize that, and you're just like, wow, these people's pain is it's for my benefit. And we've all been in positions where we keep holding on to the pain. And if you can get on the opposite side of that, people are stubborn. They're going to keep holding on. And but that's how the markets work. When there's a lot of people on the wrong side of a position and they all realize they need to get out, that's when big moves happen. And that's what happened with Tesla. And, you kind of look for those kind of opportunities.
Okay. So I'd like to ask you, was there anything about this particular trade that changed the way you traded moving forward? Or is there anything about it that you've specifically tried to replicate?
No, I wouldn't. It's interesting. I guess maybe the main thing that probably kind of tweaked how I traded going forward was it's very rare these days that I'll have, say, 18 different positions on. I actually prefer to wait. And it's like, all right, I would rather have 3 or 4 larger positions on than 18 smaller ones. Now, conventional wisdom will say, well, if you've got 18 smaller positions, you're diversified. But I forgot who said this, and maybe it was even Warren Buffett, who just said, essentially diversification is for people who, don't know what they're doing. If you're diversified, then your account's not going to change because you got some bullish positions, you got some bearish positions. If you see something that you like, then get in and focus on it. And so it really just kind of changed my outlook to one of focus. Instead of shotgunning and hoping for the best, it's like, you know what, let's be patient. Let's miss on things. But when this comes together, let's press it and, let's focus. And it doesn't mean, buying 1,000 contracts every time. But, we just closed out a Facebook trade where we had 300 contracts on it. It was a nice, like an $80,000 trade. Great. It's not a Tesla trade, but it's not having 18 different positions. Some are up, some are down. And so your account value doesn't change. It's focus. And I think that's the key.
Okay. That's a great point. That's a really great point. All right, John, well, let's do one last question here to take us out. I'd like to ask you, after 20 years, I'm keen to hear how have your goals and outlook on trading changed in the market, as opposed to your earlier years?
Yeah, in the early years, I felt a big pressure to make a big trade. Like, I've got to make a big trade. That's freedom. I can quit my job. And I think, the main difference now is after doing this for a while, you start getting confidence in your skills. So it's not like, well, you know what, I didn't make money today. That's fine. The markets will be here tomorrow. And it's just this confidence of, if at the end of the day, I lost everything and could scrape together, sell a house or something like that, that could scrape together $50,000. I'm like, the idea that it's like, okay, I can make a couple $1,000s a month trading as opposed to having to go wait tables or something like that. It's like, I've got that confidence where it's just like, okay, I can always do that. And that just comes from skill set. And that's just, it's interesting with the markets because I admire anybody who wants to try this to do trading for a living, because this is the only profession on the planet where you have to develop confidence in a situation where the result is always uncertain. Okay, there's no other profession in the world that's like that. And so if you can get to the point where you master that and you feel comfortable being uncomfortable, that's a good life lesson too. And that's just something where that's just kind of the overall idea. And so I look at trading as kind of obviously it's a monetary thing, but it's also a philosophical approach, and just kind of attack it from that vantage point.
Awesome. Okay, John, well, do you want to share with listeners where they can go to find out more about you?
Sure. So we've got our hub website is www.simplertrading.com. And if you go there, you'll see different sections. There's options, futures, stocks, and Forex. I primarily trade options and futures. We've also got other traders that we work together with. Probably our most popular thing is that if you go to Simpler Options and enter our gold room, the gold membership trial, in that room, we've got about 1,000 members. We trade options and futures, and it's a lot of fun. So we're committed to helping each other make money, teaching, and it's great. I mean, I can't imagine doing anything else. Awesome.
And you're also on Twitter as well. Do you want to share your handle?
Yeah, it's just, the @ symbol, then John F. Carter. And, I'm not I'm not posting 20 things a day. It's more kind of every once in a while I'll do like a market observation, but, I like to post kind of market turning points and things like that as well.
Okay, good stuff. Well, I'll be sure to include all those links at chatwithtraders.com in the show notes. So, John, once again, thank you very much for doing this. It's been a lot of fun speaking with you. Thank you very much.
Absolutely, Aaron. Thanks for having me on the show.